Well, hello everybody, this is Jason Wink. Today is Monday. It's about 3:30 p.m., about a half an hour before the markets close. Been a pretty volatile day today. In fact, if I bring up my daily view, you can kind of see that markets started off hugely to the upside and then sort of meandered down throughout the day. You can see that again right in this zone here on the video. Just as I mentioned last week, hope everyone had a good weekend. Things to be watching and looking out for. So something that's not on the, has nothing to do with sort of market direction, but just an update, is that this week the Fed will be meeting in Jackson Hole. So who knows what they'll come out and say. There's a lot of speculation. It could be, there's some chat about if there'll be another round of quantitative easing. For those who aren't familiar with what that is, it's basically when the Federal Reserve attempts to inject liquidity into the marketplace. And what that really means is they will, if they do something along those lines, it just may mean that interest rates stay very low and that there's more money supply for lending, which theory is that should help the economy. So it has not done a whole lot of good. They've already done quantitative easing twice. One was actually rather important. That did help kind of stop the bloodbath of 2008 and early 2009, but really the economy hasn't improved tremendously. I'll be actually writing, instead of doing a video, an update here by the end of the week on the state of the economy. Some of our research is suggesting that the economy is weakening quite significantly, and we're not the only ones who seem to think that way. Just last week, Goldman Sachs came out and lowered their forecast for the second time this year on gross domestic product here in the United States. So here's a little something that we're watching. So just back to my charts like I've shown past couple weeks. This is the, well, first off, I'll start here actually. We'll do this chart. This is the very long-term view of the market, or a longer-term view anyway. This is 15 years. And this is one where I've shown that there's been kind of this long term sort of resistance and support in the market. When it's on its way up, it's kind of stopped there, and when it's on its way down, it sort of stops there. And so we're still watching that level very closely. I think if the S&P 500, which right now is at about 1,128, so about 1,130, to me the market needs to go in the short term either above 1,150 or 60, which that's right up in this zone here, in order to resume an uptrend, if that's going to continue. And it has to be able to hold this line here. This is that 1100 line roughly. Maybe even could go down to 1050. Anyway, if it doesn't hold that, I think the downside could be potentially quite ugly. If it doesn't break out to the upside here, I think we'll just chop around until it does one or the other. So most of the short-term damage, I think, has been done. In other words, if someone didn't, wasn't like expert forecaster and saw this quick sharp decline there coming, which very few did, right now you have to kind of hold on and either be anticipating if the market will break out above this 1150 sort of 60 zone, or fall down into the 1050 zone. If it goes again below that, I think that bodes very bad for the market. Looking at this little bit of the chart down at the bottom, this is called the moving average convergence divergence. Again, MACD is the acronym. But we can see here, this has done a pretty good job of catching some of the really big declines. So when this happened here, of course, that's when the market tanked in 2007 and 8. And it also has caught some big rallies. So again, when this big positive move happened back in 03, that was indicative of the big rally that also occurred in 2003. And we can see that same type of setup happened in 2009. Big decline, big rally, and here we are looking at the longer term trend. Is this going to be, again, fortuitous to another big decline, or will it simply come down, hit that point, and then continue moving up? And you can see that does happen sometimes. See here, there's been other times in the past where it looks like it may go, and then ultimately it bounces off and the market goes to new highs. So we'd have to see this decisively kind of below there, because there's been a couple of times in history. You can see it happen here in 1998. There was a currency crisis in Russia, and that caused the market to have this big, quick sell-off. That's this that you see right there. And then it actually ended up just bouncing right back up and going to all-time highs into 2000. So anyway, that's what's happening in the long-term view. In the shorter-term view anyway, a couple things that I was taking a look at. This is the S&P looking at a shorter-term time frame, and I drew in some of these figures here a couple weeks ago. So I'm still kind of watching this. This is that shorter-term momentum. You can see that the market was in this sort of wedge, they call that. This is called a bear wedge, by the way, for those who are market technicians. And when it breached this 1200 point, again, a very bearish sign for the market. If it doesn't get back up and start a new rally, this is again indicative of perhaps another big decline. Last thing I wanted to show was, just because people have been asking me about it, was what's happening with gold. So gold keeps going and going and going. You know, we try to be right all the time, but we're not, obviously. And we sold our gold about 2 weeks ago. So we sold it when it was at about 1,660 or 1,680 an ounce. Now it's getting close to $1,900 an ounce. So you know, we've missed about 10% of the last bit of upside. But what I've been watching for is this line I drew in at the top here. That has been, you know, whenever gold gets really overbought, meaning just more and more people are piling into it, it gets up to that zone, and it almost like clockwork ends up selling off. And so we can see that it's about the highest that it's been in the last 5 years as far as how overbought it is. And we can see that again too in this little chart down here. You see the momentum just way high, higher than it's been any point in the last 5 years. And when this happens, you know, a lot of people start piling in and just going crazy trying to buy what's rising, and that doesn't always end up being good for investors. So I think that gold, while it certainly looks very promising over the next, let's say, few years, especially if we continue having financial problems in the United States and abroad, but I think in the short run, there's actually a lot more risk that this could come down. And if it does that, I would expect gold to drop up to $300 an ounce and create a nice buying opportunity. So the risk to me is greater in owning gold right now than it is in not owning gold, simply because I think that there's a very high probability that history will repeat itself. And every other time that this has happened, the price of gold has dropped a lot. And again, I mentioned this before, this drop here, which is comparable to where we are right now, took gold from around $700 an ounce all the way down to around $550 an ounce. And it did that in a matter of 5 weeks. So, and it was just every single week for 5 straight weeks it declined. From there, it caught its bearings and kept going up. And again, gets overbought, drops again. This other time here, this was $950 an ounce down to about $650 an ounce. Again, a pretty big drop before again resuming its rally. And every time this has happened, there's been some type of decline between 5 and 25%. So have to be careful there with the gold. That's it for today. I'm going to continue watching some of these different key levels, as well as listening to what Bernanke has to say. And we'll certainly report back to everybody. I hope everyone has a great Monday afternoon. And thanks for checking out my video blog.